everyone, I'm Sasha Padbidri, Deputy Editor at LevFin, and welcome to this week's episode of Syndication Nation with the Cloud LevFin podcast, where we unpack all things LevFin related. On today's episode, we have reporter Yiwen Lu and senior reporter Sunny Oh, who will discuss their recent reporting on the resurgence of the Term Loan A as a funding tool. So thank you both for joining me today.
Thanks for having us.
Awesome. Yeah, I'm ready to unpack this with you guys. So the Term Loan A market has long been overshadowed by the high-profile institutional TLB market, and TLAs have originally been used as a gap filler during choppy market conditions in the past. But recently that seems to have changed, especially, considering all the events that happened in January 2026. So can you both tell the audience a little bit about your observations based on, recent mega buyout deals, and also why market participants are describing this year as a watershed year for deal making?
I'd say, first of all, it just goes to show the huge financing needs that are out there. And that's kind of why this market has come to prominence. And just to give you a general lay of the land of how these things work, a TLA is similar in structure, but it is prepayable. It has no call protection. It's amortizes much quicker. And it tends to be a bit cheaper than TLBs. And we tend to see them more active when there's times of turmoil, as you sort of alluded to. So for example, 2022, Fed's hiking rates. The TLB market was sort of in shambles. There were a lot of hung deals, and a lot of deals had to sort of go to the TLA market. And so that's kind of how people sort of saw it as this kind of gap filler. But come today, it's being seen across a lot of LBO financings, which I think Yiwen could discuss.
Yep.
Yeah, we've seen that in all the recent deals that we cover. I remember covering this back in, I think, May of last year when I broke the news about the TLA syndication started for Samina's acquisition of ZT System from AMD. That was a pretty straightforward M&A deal, but it includes a TLA component. And then coming into late last year, we saw that in some of the mega buyouts that you mentioned. And Hologic is a big one that includes like a $1.225 billion of TLA tranche, and BioMarine's acquisition of Amicus Therapeutics, and then H&I think Dicom Industries as well. It upsized its TLAs. And of course, we're going to see it in Sealed Air and EA, which is not launched yet, but is widely expected. So yeah, all of those deals, I think, includes a TLA component, just shows how borrowers are tapping every part of the market to finance those mega buyouts. And that really leads into your next question, which is like, why are sources and market participants saying that this year is going to be a watershed year for deal making? Because really, I feel like last year, the talks industry is really lenders are curving for more new money deals, but M&A was really muted, and since Liberation Day in particular, and then. So yeah, and then when we saw those buyouts last year, sources are expecting that there's gonna be more of those this year, and especially with rate cutting expectations and the fact that lenders are sitting on a lot of new money and sponsors sitting on a lot of dry powder as well. So I feel like TLAs are going to be used more in that situation.
Great, that's good to know. You also mentioned in your recent report that TLAs help banks distinguish themselves from private credit lenders. So how does having a TLA help a bank win a deal against direct lenders if, to your point, it's going to be used more this year?
Yeah. Also funny you asked that, because I feel like we've been seeing more TLAs in those smaller deals that would traditionally go to direct lenders, that are not those like mega buyouts or M&A deals that we were speaking before. Our colleagues at the private credit team reported that West Shore Home recently tapped like a $400 million TLA to do a refi and dividend recap. So like that is kind of just an example of how TLAs has won over private credit in a way. And really, I think the difference is, as Sunny mentioned, it is a lot cheaper as a financing tool. It really kind of shows how the banks can also move up quickly compared to like in a traditional TLB syndication. You have to get like rating actions done, and you have to like wait in a public syndication process. And this just moves a lot faster and is a signal to borrowers that banks can do what direct lenders are offering as well.
Got it. Just out of curiosity, could you tell us more about one prominent example of, a TLA structure? Because I think for me, Hologic comes to mind.
Yeah, I think we spent a lot of time reporting on the financing structure of Hologic. And so as I mentioned, it includes a 1.25 billion TLA. And on top of that, it's a loan-only structure. It upsized the TLB syndication portion. And it's now like 7 billion. And at a time when its pricing is totally oversubscribed. And also it includes a privately placed second lien tranche. So when it comes to the TLA structure, and I think when we're reporting on how they decide on the financing process, one thing we learned that is arrangers really wanted a prepayable structure. Mm-hmm. And so that's when a TLA came to mind, because it doesn't have, because the TLA portion doesn't have a call premium, and the TLB portion has I think only a 101 soft call for 6 months. So that is kind of what made the structure more appealing to both the borrower and also the broadly syndicated market, because having the TLA out there is really a signal to lenders that the arrangers themselves are confident in this deal, and so that they're willing to put their own capital down. And for this, TLA is also cheaper in this deal. I think it's in the SOFR plus 250 basis points range, mm-hmm. which is cheaper than the publicly syndicated portion. Yeah.
And I think it's important to remember also this gets done, the TLA portion gets done a bit earlier. Mm-hmm. So you're kind of de-risking the transaction. You limit the amount that actually has to go through the TLB market. And we're sort of seeing this with EA. I think our colleagues, Bill, has already reported that they're getting through the TLA portion. And so the amount of eventual financing that will hit the institutional market for, us seems like it'll be much less. And so it just makes execution much easier. It makes these bigger financings digestible. And I think the institutional investor base likes to see that.
Yeah, I guess also to add on to that, the TLA usually has a shorter tenor. I think for Hologic, for example, the TLA has a 3-year tenor, which is, a lot shorter than a traditional TLB. And then that means it essentially kind of functions as a bridge loan to some sources.
Got it. No, that's good to know. Another thing you mentioned in your reporting is that, TLAs have an evolving holder base, and it's changed quite significantly over the last few years. So what's different now?
We've been hearing that there are a lot more participants, because as Sunny mentioned, usually banks would participate in a TLA loan, and sources have been saying that usually you in the past you might just only have single digits number of banks participating in this, and now that has really expanded and also expanded in the type of banks that participated in this loan. We're seeing more regional banks and Asian banks taking on TLAs is a way to deploy their own capital as well, because the growth of loans has been quite limited in the past few years.
Yeah, no, I think it's definitely grown. It's diversified, and I think just having this diversification of geographies is quite helpful, right? Let's say financial conditions get choppy in one geography in Asia or something. You can rely on, let's say, Europe or some of these U.S. regional banks. It just helps to spread out the counterparties. So I think it's probably good news that the buyer base is deepening for this market.
Great. I mean, honestly, as someone who's covered the market for a while, it's good to see how much it's changed over the years, and it's really interesting that you guys are tracking it. Since we've already talked about the pros of TLAs, are there any potential cons? Has anyone you've spoken with, mentioned any downsides of this resurgence of TLAs?
I think one thing we've been hearing repeatedly is that banks are not planning to hold on the TLA loans that they took on. This happened a lot in the past, especially when during 22 during the gap filler phase of TLAs, where it was really seen as a tool to make up for the financing that couldn't be reached in the publicly syndicated market. And once after 6 months or so during the period when banks were mandated to hold those loans, they would tend to sell those loans at a huge discount and to a lot of lenders and a lot of institutional lenders, this really hurts the technicals of the TLB market. And so like that's one thing that people didn't really want to see. But also I think we've also been hearing banks saying that that is no longer the case. They are willing to hold on to the loan for longer.
Yeah, I think some of the TLB lenders, for example, in like Hologic, were particularly worried about, some of these TLA guys flipping the loan. But, it seems like there were enough of reassurances, and some of the TLB guys were comfortable with that. And I think it also depends on, the kind of person that's actually underwriting the TLA. Let's say you're more of, because we can't name names, let's say you're more of an investment bank profile. You're not in the name of the game of the name, or the name of the game is not to actually keep the loans on your balance sheet. You're an underwriter. So you're doing this just to keep business flowing. You're showing you're a good partner to your clients, but ultimately you don't want to keep this. But let's say if you're a regional bank, loan growth is hard to find. I think for those guys, it does matter being a buy and hold lender. And I think the clients very much appreciate that. So yeah.
Yeah, I guess another thing that I would add on to this is that the market doesn't think that TLA is going to be the main financing tool, even though we discussed really the resurgence of it. The main thing is because borrowers don't see it as a particular the main thing is that borrowers don't see this as particularly appealing exactly for the reasons that we discussed before, that TLAs has like a shorter tenor, and it also often includes a maintenance covenant compared to like a covenant structure. That means that that means that the covenant would be triggered once in any situations when a borrower is financing, like a financial situation declined even before the borrower missed a payment. So that's kind of like more strict than a covenant structure. And also that just the fact that like banks could sell it. So in a lot of ways, we've seen more of TLAs, but it still remains a doubt on just how large this could get.
So it kind of just reduces the flexibility for the sponsor, right?
Yeah.
Like that's kind of why the TLB is the preferred option in the end of the day. And, maybe you insert a bit of TLA depending on how confident you are able to sort of deleverage and prepay that debt.
Great. Thank you both for unpacking this situation with me. I really learned a lot. And to our listeners, if you would like a copy of the TLA story, please reach out to us at podcast@9fin.com. And thank you for tuning into this episode of Syndication Nation. We hope to see you again next time.